welcome to the session 4, which is also our last session of the day. We're going to have one full presentation and then 3 flash presentations. So stay with us until the end. The first paper is by Guido Ascari, and it's on the employment concentration channel of monetary policy.
Thank you, Matteo, and thanks to the organizer to invite us to present this paper. This is a joint paper with Andrea Colciago and Marco Membretti, and the usual disclaimer applies since we are all working for institutions also. So what this paper does, so in one sentence, contraction in monetary policy does not only reduce aggregate employment, but it changes how employment is distributed across type of firms, because there are small and high churn firms that contract disproportionately. So employment becomes highly concentrated or more concentrated in large incumbents. And then you may ask, okay, why does that matter? Well, it matters because monetary policy shocks not only affect demand, but also supply via entry-exit response. And they affect, in particular, the number and the type of firms that produce. And this composition margin is important because it shapes the output-inflation trade-off that monetary policy is facing. OK, that's what I will try to convince in the next 20 minutes. So what's new, I think, in these papers, I don't know if Sebastian agrees, but relative to the existing firm dynamics models, our contribution is to embed a quantitatively disciplined firm size distribution with realistic employment concentration and size-dependent exit into a fully fledged monetary policy model, and to show exactly that this cross-sectional discipline of the model is essential to nail down the output inflation trade-off in the data. These are US data. The mechanism goes from monetary policy to entry-exit response, firm size distribution, and output inflation trade-off. So as a motivation, if you look at the data, these are BDS data for the US economy, new entrants, is only 3% of employments because these are typical small firms, but yet they count a lot cyclically because it's 50% of gross job creation. This is known. This is also known as, large firms have very tiny numbers of large firms, about 0.5% of large firms. However, they amount to 50% of employment. They are large. And another thing that is known is that small firms have a much higher exit rate than large firms. So most of the dynamics into entry and exit is actually borne by small firms. So the question in this paper is, how does monetary policy interact with firm size heterogeneity? The model is able to reproduce aggregate responses to monetary policy and the cross-section that governs firms' entry and firms' exit and employment concentration. So in particular, the model matches simultaneously by construction or by estimation, the stationary, so the model is estimated on US data, the stationary distribution of firms by size, the stationary distribution of employment by firm size, as just as told you, the size-dependent exit rates, and also we do impulse-response function matching to monetary policy shock. So we try to do really this micro to macro regarding firms' dynamics and aggregate responses to monetary policy shocks. We are also matching some untargeted data, untargeted job creation, job destruction by moments, firms' dynamics impulse-response function to monetary policy shocks. And then we build a Phillips multiplier as a measure of the output inflation trade-off. And the main message is that the empirical firm size distribution matters for the transmission of monetary policy, as I said. So what's the mechanism? Monetary tightening does not affect only aggregate demand, as I said, but also change the supply. And 2 micro features that our model has and match are important. The first one is employment, and we'll try to convince you through counterfactuals. One is employment concentration, so how employment and production are distributed across firm size. And the other one is size-dependent exit, so which type of firms are more likely to disappear after the shock, and these are the small firms. So there are two margins that I will highlight at the end of this talk. One is the so-called shift effects when you have a monetary contraction and monetary policy shock. How many firms exit matters, because that's the matters because it determines the contraction in supply. So higher exit reduce the mass of active firms and shifting supply also inwards. And that's a kind of extensive margin, so how many firms will survive. And then there's a slope effects with regards instead which firm exit and which firms do not, and how this contraction is actually distributed across the firms that remain in the market. And that's more about the intensive margin, how the existing firm change their production. So the key takeaway is that monetary policy affects not just aggregate employment, also the distribution of workers across firms, and we need to take into account a realistic employment concentration and endogenous size-dependent exit. And the bottom line is that the output inflation trade-off is endogenous and depends on the firm size distribution. By affecting entry and exit, monetary policy change the supply side, and that has effects on the transmission mechanism that depends not only on how much demand falls, but also on how many firms enter and exit and which firms do so. So that's the introduction. So let's look at the empirical evidence. So we're going to look at two data sources. So one is Fred, the second one. The first one is this BDS data, but these are annual data. So we'll look at entry-exit rates, job creation, destruction, employment shares by firm size. There are three groups of firms that we identify: large, which is bigger than 500 employees, which is standard in the literature; small, and entrants. We're going to build a B-VAR with mixed frequency because we have annual data and quarterly data. There are two variables in the annual block of the VAR. One is the employment share of firms with at least 500 employees. That's what we call employment concentration, is how much employment is concentrated in large firm. And the second is the entry rate of new firms, defined as the ratio of newborn firms with respect to the total number of firms. The rest of the data, quarterly data, are standard. You have GDP, unemployment, GDP deflator, and so on and so forth. So what we do with the mixed frequency BVR, we identify monetary policy using side restriction in this particular way. So which is actually, to some extent, rather standard. So the sign, of course, interest rate goes up, GDP inflation goes down. And we impose these signs for 4 quarters. We do robustness in the appendix with the Jaroszynski-Karady shocks. Then we look at also this object, which has been popularized by Gerd Mertens. So this is the Phillips multiplier, Robuchon and Mertens, that measures basically, is one measure of the output inflation trade-off. Is basic, what we're going to do, we're going to take the ratio between the input response of inflation and the input response of output up to some horizon, and the higher the Phillips multiplier, the better is the trade-off, because you can change inflation with less output losses or changes. That's the only thing you need to. So that's the results. So after a monetary policy shock hits, employment concentration, which is our main object of analysis, that's from the title, rises, and rises in a very persistent way. And that's because supply is slow to recover, because it's about the entry-exit, and all these dynamics takes time. Unemployment rate also increase quite persistently. Of course, GDP goes down, inflation goes down. This is also imposed, as I just told you, in the identification. The entry rate goes down, and this is the cumulative Phillips multiplier. Then we take the shocks that we identify, and we use them in local projection on these annual variables. And then you can see the first row is about job creation. And you see that job creation overall follows a bit the job creation of expanding firms. These are generally large firms that stay on the market. But job creation by entrants goes down simply because entry goes down a lot after a contraction monetary policy shock. Here you have job distraction, and job distraction again is mainly concentrated, as you can see here, in the small continuing firms, of course, because these are the firms that continue in the market. And then you can see the exit rate goes up, and therefore, as a consequence, net entry goes down. Job distraction by exit, of course, goes up, which again tells you that most of the movements, this is kind of known in the literature, comes from the entry-exit dynamics at the cyclical frequency. So this just summarizes what I just said. Job creation, aggregate job creation is mild, not significant decline, but is basically concentrated on new entrants. Job distraction is also concentrated in small firms, and job distraction at large firm is basically unchanged. So large firms are basically unaffected and are insulated by these contractions, and all the movements in the entry-exit, job distraction, job creation, most of the movements comes from small firms. So there is an asymmetric impact. Small firms bear the brunt, while large firms are insulated, and employment concentration therefore rises. So that's what we call the employment concentration channel of monetary policy, and going to reflect a deeper compositional mechanism on the supply side by affecting entry-exit and both the mass and the composition of active producers. So the model. So I don't have time to go in the details of the model. The model is rather complex. It's also beyond my capability to do so. But so these are the main ingredients. It's a representative household model. There are members that are employed or unemployed, and they insure each other. There are 3 layers of production firms. And these are where the action take place. They have heterogeneous productivity, and I'm going to talk about how we introduce that and how we distinguish between permanent and transitory component. Entry and exit, hiring and firing, search friction. So this is a model that also have equilibrium unemployment. Retailers are there just to put price stickiness, so they pack these goods, which are homogeneous, produced by the production firms, and then becomes differentiated. They put a ribbon on it, and then they sell it with nominal rigidity a la Rothenberg. And then there is a final good producer that produces an homogeneous good that is consumed. And this is also standard. We also introduce real wage stickiness in the model, and then the model is a Taylor rule. So the only thing I want to kind of get a little bit more in the details is how we model small and large firms, because this is exactly the distinguished features of this model. So this is the production function. In the production function, you have 2Z. The capital Z is a permanent productivity level that firm draw on him when he's born. And then every period there is also a transitory component, right? So you can think of the distribution of these firms. So the capital Z, there will be a large one and a small one. So we have large firm and small firms. The probability to draw a large capital Z is very, very low, because there are very, very few large firms. And so you can think of the distribution of the firms in our model as almost bimodal. So you have a distribution of large firms. So within large firms, anyway, you have this transitory technology shock, and also a distribution of small firms, right? So that's the overall distribution of firms. Okay. So that's the timing of events. After monetary policy shocks, if you're a potential entrant, you pay an entry cost, you do your permanent productivity, and you wait until T+1 to produce. Time minus one entrants, so these are guys that have entered the previous period. They draw an idiosyncratic productivity shocks. They draw a fixed cost of production, and they decide whether to produce or not. If they produce, they hire workers through a search and matching model. Incumbents firms, they draw idiosyncratic productivity shocks. Again, they have a fixed cost of production. They can decide whether to exit or to continue, and in which case they adjust their employment, again, by posting vacancies and hiring workers. So we're going to estimate this object. What can I say about that? Well, look at the paper, I guess. So we do impulse response function matching, but in this model, actually, we do something a little bit different. And the reason is because some of the parameters are important for the dynamics of the model, but also for the steady state distribution of the firms. And therefore, we need to match both of those. So we have impulse response function matching in a standard way, plus a penalized term that penalizes this deviation from the steady state distribution. Okay, that's everything I want to say about that. That's the stationary distribution in the model and in the data. And you can see that the model actually does a pretty good job, in my opinion. So there are targeted moments. And you can see here that in the data, there are small firms. There are the vast majority, about 97% of firms are small, and only 4% are large. But they both count for about 50-50 in terms of employment levels. And the model reproduces exactly the same stuff. And the model is also able to reproduce the firm's dynamics exit rates, so state-dependent exit rates. And you can see here that the exit rate of small firms is much bigger than the one of large firms. Large firms is basically zero, they never exit. That's both in the model and in the data. So the firms that enter and exit are the small firms, which are near the cutoff of the productivity level, and when monetary policy, contractual monetary policy shock hits, then they exit. And this is an untargeted moment of job creation, job destruction, again, by firm size and by firm employment by size. And you can see, again, that the model does a pretty good job regarding also these flows. And these are not targeted in the estimation. So, again, job destruction is by exit, as you can see, is mainly concentrated in small firms because, again, large firms never exit. Okay, transmission monetary policy shock. So we're going to do impulse response function matching, and that's the results. So I think the model does a pretty good job in matching employment concentration dynamics, which is one of the distinguished features on which we concentrate on. GDP and inflation rate, and also the in a nutshell, I can call it the output inflation trade-off, which is the cumulative inflation multiplier. Inflation output multipliers, or by Barnichon and Mester. We're not very happy about the unemployment rate dynamics here, but I think overall the model does a pretty good job. The model also, we can do impulse response function with actually replicate exactly the flows that I show you in the empirical analysis before by local projections. And again, at least qualitatively, we get both the job creation flows by firm size and the job destruction and the exit rate and net entry that goes down. Okay. So in the rest of the time, let's try to think about what are the mechanisms here and why it is important to have, as I said before, both these important margins, which is the employment concentration and the size, the exit, state-dependent exit. So entry and exit affects the monetary policy transmission through two main channels or margins. The one is the one we call it the shift effects, which is how many firms enter and exit, and this is going to shift the aggregate supply, right? So intuitively, it's a lot of firms exit, and the aggregate supply shifts more. So higher exit and lower entry, which after the contraction monetary policy shocks, is going to shift aggregate supply inwards. And again, how much this is going to shift is going to depend on the firm's distribution and how many firms are close to the cutoff. The second one is the slope effect. So which firms actually, that's about the intensive margin, how firms that remains in the market adjust their production. And a monetary tightening, as I said, changed the composition via selection of active firm, and is going to shift the production towards large incumbents. So the price quantity response also depends on which firms enter and exit in a way that I show in a minute. So we're going to convince that both margins are important, and we do that by two counterfactual. The first counterfactual is by asking what happens in the model if we have exogenous exit. So exogenous exit, it means that exit is fixed, right? As you can see here. So the red line is the counterfactual, the red dashed line, the blue is the model. So in the model, what you have here is obviously that since exit is endogenous, exit increases after a contraction monetary policy shock. So if you force the model instead to have a fixed exogenous exit, as in many models in the literature, then what you have here is that the output is going to decrease less and inflation is going to decrease more. Why? Well, simply because less firms exit, and therefore the shift in aggregate supply is going to be lower. So you have more firms, more production, and you have more production. In order to sell this production, prices have to fall more, very intuitively. So inflation is going to fall more. Of course, this model by construction, this counterfactual, is not cannot match employment concentration. That's exactly what we want to do, and also the job discussion by exit because exit rate is exogenous. So this mechanism highlights the fact that when you have exogenous exit, you shut down the endogenous response to monetary tightening of exit. Exit, therefore, no longer increases. The massive firms contract less, and therefore the inward shift of the aggregate supply is muted. That means that there is more productive capacity, and therefore inflation falls more. The model overstates the Phillips multiplier. And therefore, this is about what we call the shift effect, so how many firms exit the market matters. The second counterfactual is about low employment concentration. So now we have a model in which firms are homogeneous, almost. So we basically shut almost to zero the number of large firms. So basically it's a model in which all the firms are small. So this is a model in which you have a lot of firms concentrated on the cutoff because they are more homogeneous rather than in our benchmark model. So what happens here is that when there is a contraction in monetary policy, in our model, a lot of firms, small firms exit, and the large firms has to adjust cut their production. So the cut of the production is concentrated on few firms, large firms. That means that they have to travel along the marginal cost schedule quite a bit. While you have a lot of homogeneous firms instead, then there's a higher number of firms that divide the contraction among them. The contraction is more broad-based. And therefore, each of these firms travel along the marginal cost a bit less. That means that prices are going to fall less for the same level of output because the contraction in output is more broadly distributed across homogeneous firms. And that means that the model would understate the Phillips multiplier. So this is not about a shift, this is about what we call the slope effects, it's about the slope of the aggregate supply. So monetary policy is not gonna only change the aggregate supply by shifting it, but also changing the slope of the aggregate supply by what we call the intensive margin adjustment, because the effects of the shock is distributed differently in these two counterfactual across surviving firms. It's more broadly in the counterfactual, more concentrated in our model. So which firms also matters for the adjustment, which firm survives matters for the transmission of monetary policy. So then you can say, okay, this is not a fair comparison because we have an estimated model, which is the blue, while the red, which, this is counterfactual to try to understand the mechanism in the model. But anyway, we can estimate both versions of the model in the data to give both versions of the model a fair chance to match the Phillips multiplier. So we're gonna estimate the model, and that's what we get. So that's our baseline model. And as I said, I matched the cumulative Phillips multiplier quite well. While the exogenous exit model is going to overstate, as I explained to you before, the Phillips multiplier, and the homogeneous firms model is going to understate the Phillips multiplier. And this, this basically we estimate with the same methodology the two versions of the model, restricted version of the model. So we give them the fair chance to match exactly as our model. And also another thing that we observe is that the parameters are not very different across the estimation exercise. which means that our counterfactual are even more relevant. But also means that this is really about the structure of the model, right, rather than try to matching the data. Okay, so this model cannot actually match the data, or at least the employment concentration dynamics, which is important for the monetary policy trade-off. My time is over. So what's the key message of this paper? The output inflation trade-off is not a primitive of the economy. It depends on how many firms enter and exit and which firms enter and exit. So it's endogenous to the firm composition, to the share of employment in fragile small firms versus large incumbents. And therefore, for example, in terms of policy, central banks operating in an economy with low concentration face a worse trade-off than an economy with high concentration. And the effect is particularly strong in a model like ours, in which the distribution of this permanent productivity is very dispersed. Thanks.
Okay, well, thank you very much to the organizers for inviting me to discuss this paper. Okay, so let me just briefly summarize the paper as I see it. I think the research question really is, how does firm entry and exit, and maybe more broadly firm dynamics, affect the monetary transmission mechanism? The way that the authors do that in this paper is a sort of a two-pronged approach. They're going to answer using new empirical evidence coming from this mixed frequency Bayesian VAR identified with sign restrictions, and also this sort of these supplemental local projections. And then they're going to answer this using a heterogeneous firm New Keynesian model with search and matching frictions in the labor market. So for those of you perhaps familiar with papers in that area, this is basically the model of Ellsby and Michaels extended to allow for entry and exit and extended to allow for sticky prices. The main findings are that a contractionary monetary policy shock leads to a significant rise in what they call employment concentration. So employment concentration they define as the share of employment in large firms, firms with at least 500 employees. They're going to estimate their model to match these impulse responses, so the impulse response of employment concentration and also the response of other macro variables, unemployment, output, inflation. And the model's going to do a good job. So the model's going to fit their impulse responses. And with that model, they can think about these various counterfactuals. They can show that the primary mechanism that's generating this rise in employment concentration following this monetary policy shock is an increase in the exit rate of small firms. And Guido mentioned these two counterfactuals. The one that I would focus on is the first one, so the one with exogenous exit. There's a smaller drop in output, a larger drop in inflation following a contractionary monetary policy shock. And so firm dynamics are relevant for the size of this Phillips multiplier relating changes in output to changes in inflation. So my discussion. I think it's a very interesting paper. I'm convinced that it's very convincing that firm dynamics and the presence of entry and exit can matter for monetary policy. It's a very rich model, and the model has lots of predictions. And I think, to me, the main constraint is the amount of data that we actually have on these firm dynamics variables. So I'll talk about that a bit. My discussion is going to be in three comments. First, on the empirics, I want to talk a little bit about the cyclicality of employment concentration and how to estimate the response of other variables. I want to talk about the role of entry, which I think is a bit less focused on in the model in the paper at the moment. And I also want to really talk about the trend in employment concentration over time. So here is two time series plots, just to sort of set the scene. The top one is their measure of employment concentration. So this is data from the Census Bureau's BDS database. Runs from the late 70s to early, or to now, but in the paper they're using 83 to 2018. And you can see there's a strong upward trend in employment concentration. So large firms now account for a much larger share of employment than they used to. Cyclicality-wise, it's a bit less clear. So I think if you sort of squint, you can see that following recessions, employment concentration perhaps does tend to fall. In the big recession in that sample, we actually don't really see that. So this trend is sort of continuing through 2009 without really changing. On the bottom, I'm plotting firm entry and firm exit. They also see these related trends, so they're both declining over time, particularly firm entry. Here, the cyclicality is a bit more obvious. So firm entry is pro-cyclical, firm exit is counter-cyclical. We can also sort of do the same thing a bit more formally by looking at the correlation of these variables with unemployment or GDP. And you see basically what I've just said. So employment concentration is modestly, I would say, counter-cyclical. Firm entry is quite pro-cyclical, and firm exit is somewhat in the middle. And I guess that's my first sort of comment here is Michael talked about earlier about the benefits of moving from quarterly to monthly data. Here we're stuck in annual data with about 35 observations and employment concentration here is the main variable, and it's not showing much unconditional cyclicality at least. So this is the sense in which I think that the data is a bit of a constraint. So just to show their main impulse responses again, after a monetary policy shock, they find that there is actually this significant countercyclical move in employment concentration, and the response of entry is comparatively muted. So at least compared to the unconditional variation, this is a sort of bit of a surprise. I added their employment concentration variable to a VAR from a recent paper that I have, where we're looking at the response of labor market variables to monetary policy shocks. And the disclaimer being here, I've taken the liberty of a discussant. I've taken the annual data, I've converted it to monthly using the Kalman filter, and I've plugged it into our VAR, and it's shown in the bottom right-hand corner. And so here I would say, in response to a contractionary monetary policy shock, at least through the lens of our VAR, we see basically no response of employment concentration. If anything, it goes slightly in the opposite direction. So that's, I think, one thing that I think the authors should sort of focus a bit more on is the robustness of that. Secondly, the response of these other variables. So the way they do it is then take the estimated monetary policy shocks from that first Bayesian VAR, I guess aggregate them to an annual level and then use them in these local projections. And here, the responses of all of these other variables, I think because of that process, are quite noisy. So what I wonder is there not a way of getting slightly more accurate responses for these variables? Could they not also be added to this mixed frequency VAR if that's going to add too many variables, perhaps one by one? Because at the moment, I feel like the model has lots of interesting predictions for all of these variables, and it's currently a bit hard to relate those predictions to the data. OK, second comment is on the role of entry. So far, I mean, as the way that Guido presented it too, the model is mainly focused on, I would say, the exit margin, comparing the exit rates of small and large firms in the data in the model, looking at this counterfactual with exogenous exit. And in the current model, that makes sense, because the entry margin seems relatively unimportant for shaping employment concentration. So here I'm reporting again those impulse responses for the counterfactual where the exit rate is exogenous rather than endogenous. And if you look at the bottom left panel, you'll see that in this exogenous exit counterfactual in red, there's basically no movement in employment concentration. So it seems like all of the action is on the exit margin in the model. I wonder, really, if that is kind of baked into the way that firms grow in this model. So this is the value function or my version of the value function for one of these firms. They have these two productivity processes, and their current level of employment is n-1. And what they're choosing today is employment in order to maximize their value, and that's going to employment today is going to obviously increase their production. When they are choosing this level of employment, the only place that n-1 shows up is in this adjustment cost here. So this kappa times by n minus n-1 over q is the hiring cost that they're paying if they're choosing to expand. And so in this model, a firm that is expanding is going to hire new workers until the marginal value of an additional worker equals this hiring cost that's coming from the search frictions. And this is completely independent of n-1. So in this model, if a firm is hiring, the amount of hiring that they do is going to be completely independent of their current level of employment. New firms are going to grow very fast, therefore, and perhaps new firms are going to quickly look like existing firms, and so that might be why entry doesn't seem to be particularly important in the model. We could compare that to the data, and in reality, it takes firms a long time to get big. So this is just 4 histograms showing that even after 5 years, in the data, firms that are 5 years old tend to be small. In their model, I think firms that are 5 years old will have already converged to the stationary distribution. And there's ways, I guess, simple ways that the model could be adjusted in order to slow down this growth process. Let me just finish then by going back to this trend, which I think is really the interesting thing that is currently under-investigated. In the introduction and conclusion, they note that this significant rise in concentration through the lens of their model must have changed the effects of monetary policy shocks, but they don't undertake what I think is the natural exercise of calibrating the model to firm distributions at the beginning and end of their sample, and then seeing how monetary policy shocks behave differently for in those two different worlds. To me, that would be interesting and seems like quite low-hanging fruit for the paper. So I'm over time. Let me finish there.
Okay, the floor is open for questions. David.
Well, thanks for this very nice presentation and discussion. I'm curious about an aspect of the model. So one implication is that through the entry and exit and the search friction mechanism, if I understand correctly, your model implies that changes in monetary policy will lead to a change in aggregate productivity, in the sense of labor productivity, output over employment over time. So I was wondering whether this could be used as a way to validate your model using empirical data, because we have data on aggregate productivity at the quarterly level. And the second question is, it's not obvious to me what is the relationship between aggregate productivity and labor concentration. I could think of mechanism going in opposite direction. I can think of a world where concentration there is too much concentration or too little concentration, and as a result, increasing concentration may lead to higher or lower productivity.
Rest.
Just along the veins of what the discussant mentioned about the lack of data, just to before someone mentioned the curse of the euro area, but in the euro area we also have different markets, and it's known to be the case that, for example, Italy is supposed to be a country with relatively small firms. France has a much higher incidence of large firms, and so I wonder whether you could use that. I understand, of course, the challenge of getting micro data for all the countries, but maybe at least showing what this would happen, whether you would have different implications in terms of the aggregate response of monetary policy, of inflation, for example, to monetary policy shocks. It could be interesting.
Great talk and great discussion. 2 comments. First, I was not sure why search and matching was in the model, and I was curious about that. Second, I like very much the distinction into shift and slope to think about the role of firm dynamics for propagation. But then then the counterfactuals were not, at least to me, were not clearly disentangling those 2 different effects. Like if you make exit exogenous, for example, you change shift or you turn that off, but you also change, the slope should still respond, because if the wage rate changes, the concentration, the firm distribution, the firm size distribution should also change, and the same for the second counterfactual. I'm curious to hear you about that. But and maybe you could, there's a way to restrict firm choices to really keep the shift and the slope part constant. Thanks.
Ben? Please.
Yeah, following up on the idea from Seb on a historical change in concentration, do you at least have an idea of whether more concentration among big firms would lower or increase the Phillips multiplier? Because it is closely related to the slope of the Phillips curve that many people have argued has declined over time. And I want to talk a lot more with you in private after that. But.
I'll try.
Can I ask one more question?
Yes, of course you can.
So maybe it's for another paper, but there's a so it's a cheap comment, but there is a lot of literature, obviously, on how size of firms also relates to their financial positions and their ability to absorb monetary shocks, which obviously affect the cost of capital. And I don't think, obviously, your paper can say much about that, but one would think that when you think about small versus large firms, that's an important margin that you may at least want to address in a way.
Yes, thanks. So, okay. So first of all, thank you very much, Seb, for your fantastic discussion. Lots of food for thought. One thing I should have said at the very beginning, this is the first time I presented, so there are still some moving parts there, but and any comments therefore is extremely useful at this stage. So data availability and conditional volatility. So it took a lot of time, to think about and write this paper. And at a certain point, we were thinking about looking at different shocks and therefore looking at conditional volatility. While then we decided, exactly for some of the reasons you pointed out, to concentrate on monetary policy shocks, not only because that's what my interest lies, but because this is really conditional volatility. So I don't know very much what to say about the data that are fully unconditional with respect to the exercise that we do. On the other hand, the response that you show, and the robustness. We have a robustness exercise, as I mentioned, using the Jaroszewski-Karady shocks. But if we can share your data, we can surely look at robustness regarding of the response of employment concentration. I'm talking about conditional monetary policy shocks in other specifications. Exit or entry, you are completely right. So this is a model in which firms, when they decided to enter, immediately get to the optimal size, right? So that's a feature of the model. It's counterfactual because as you just showed, we know from the literature that actually takes time to reach the optimal size. That's because we don't have adjustment cost in the model in employment. So we have a cost, which is the vacancy cost. So, but as soon as you decide to enter, you post how many vacancies as are necessary to fill. To reach the optimal employment. How much this matters in the model, we can try. We will try to see if that matters. But our counterfactual is not about the fact that entry does not matter. It's more about the fact that exit do matter. So we can also try a counterfactual with the exogenous entry. And this goes back to one question by Matthias, I think, about the exogenous exit and the slope and the switch effect. Well, actually there, all firms have the same probability of exit. So both large firms and small firms exit exogenous at the exogenous rate. So the composition is not changing. So in this sense, we think that this is at least in a general equilibrium framework the best we can do to isolate, the effect of a change in employment concentration or composition of firms, and in a switch effect, which is a contraction in total overall supply. About the trend exercise, that's what your third point, and also another point there. I think we added in a certain point in the paper, we calibrate exactly as you suggest. The effects were not that big, which was the reason why probably in the last version they are not there. And despite this was also our original motivation, no? To think about how monetary policy transmission has changed over time because concentration has been changing over time. In our model, it seems that this doesn't have a great bite. It might be the case that, for example, the way we model the production sector is competitive model. So there, firms have no markup. So price, that just tell price equal marginal cost. You have large firms that produce up to the level of the marginal cost equal to the price. So that might be, one reason why we don't find big effects, because we know from Filippo and many others that the decline in business dynamism and the increase in employment concentration also comes with an increase in markups, and that might have sorts of effects that we are not able to catch on in the model. Davide, aggregate productivity, you are completely right. In our model, we actually also look at that and also try to see if there was in the data. To be completely honest, we didn't find any convincing response in the data, and therefore we didn't look at that in the model. But we didn't put in the paper. In the model, it's true. So in this particular type of models, large firms are also more productive, and therefore concentration can be beneficial, right, in terms of aggregate productivity. So that's what happens in general. That's this type of models, you have a cleansing effect in which recessions actually tend to increase aggregate productivity. Of course, you can put in the model some other features that might mute that. Last but not least, thanks Oreste and Matteo for suggesting next papers. So one is to look at cross-country evidence across Europe, and that's a very good suggestion that we can do. I'm not sure we will do financial friction. So we had financial friction. We had working capital constraints in the model at the beginning. But there is Ottonello Wimberry, and then there's a very large literature looking at that. So actually, on purpose, we decided not to have financial friction. Financial friction, if anything, are gonna probably reinforce this mechanism, I would say. Thank you very much for your comments.
Thank you all.